All right, everybody. Welcome to IBC MHS Chapter 5.2. We're doing management buyouts, LBO investment, and identifying LBO candidates. So if you could, scan the attendance so we know you're here. I'll give you all a few seconds for that. And here's the link for our website, and then our link tree. So let's get into it. All right, so starting with management buyouts. First, we have to take a step back and look at an LBO, or a leverage buyout. So LBOs are mutually agreed upon by both the sponsor firm and management of the target company. And the key takeaway to take about these is they are not hostile takeovers. So as we learned a few units back, that a hostile takeover is when a sponsor firm, or the people that are putting up the money, are acquiring the target firm against their wishes. And they do this to make a profit and also replace the management of the target firm. The key difference here is that the management of the target company is agreeing upon this, and we're going to learn about the reasons why. So LBO firms look for well-managed companies that are underappreciated, and a management buyout is many LBOs are enacted by the management of a target company and result in the management having a larger amount of ownership within the target firm. These usually occur when the founder of the company wants to exit and the team wants to stay in the company, like the management that we were talking about. And this can usually be the reasons like retirement or just for a payoff. And management usually buys because they believe in better future prospects of the company, they want to change the direction of the company, or they want the same positions within the firm. So the key takeaway with the management buyouts is that the management of the target company is staying with the company. They aren't being replaced, and they are the ones that are doing this buyout.
So the other kind of LBO is, or these are the sponsors of the management buyout. So what about LBOs that aren't enacted by the management of a company? Those that are enacted by a private equity firm or other LBO sponsors, right? So private equity firms will bring in expertise to the management of a target firm rather than replacing them. So they will aid in executive decision making to unlock value of the target firm whilst working with the management team as advisors and or having seats on the company board. So just the important takeaway from this is that the private equity firm is an active investor. They're not a passive investor of that company. So to aligning management interests. So LBOs will privatize firms. So this is basically the opposite of what we learned about towards the beginning in like Unit 1 about when a company IPOs. So they go from a public company to a private company. And in this, the ownership is more concentrated. So the ownership will retain ownership for a longer periods of time to basically favor the long-term investors. So when a company needs to be redone, it's possible that the decisions that need to be made right then are not best for short-term investors or best for the company at that certain time. So they will go private so that way they can make those decisions that will help them in the long term without facing short-term scrutiny. So another important thing is that an LBO structured firm has much more risk than a public firm. So in an LBO structured firm, they're taking on a bunch more debt. So if that company does not perform to how they're supposed to, then the company could go under. So equity warrants and options. This is basically when a company will pay their executives partly with a security, or for example, a stock, right? So the people who work at the company, they're actually getting paid based on how they perform or how the company performs rather than them just chasing a salary.
Thank you, Reed. Yeah. So, like what Reed was talking about, now we're going to go into investing in an LBO. So, most institutional investors, as we know, hedge funds, mutual funds, things like that, will invest in an LBO through a fund set up by some kind of LBO sponsor, i.e. a private equity firm like Goldman Sachs, things that we've discussed a lot. And private equity firms or other LBO sponsors that have set up funds for investment have a great track record, will often have many limited partnership interests of funds they sponsor available for new investors. So the analogy we're having for this is, for example, Bugatti. You all know Bugatti, really nice cars. But to buy a new Bugatti, the line is crazy. Think about it. Every year that when they come out with these new cars, they have really rich billionaires, tycoons, people in Dubai. They get those cars immediately. So to get a new Bugatti, you have to pitch basically. You have to beg them to take your money to get it. And this is exactly what private equity firms in their limited sponsorship available for new investors. So institutional investors will typically invest in a fund of funds in order to mitigate risk. And so a fund of funds is an investor's money is spread through multiple PE or private equity limited partnerships, so rigorous due diligence is not required. And by due diligence, they mean background information, financial statements, the work that goes into making these investments. And this has a lot of benefits if you want to do something that takes less risk. So the pros are great for smaller institutional investors that want exposure to this asset class but don't have enough capital, so people that want to get into the investment but don't have an insane amount of funds to do so. And also they don't want to invest in due diligence teams, as I was talking about. They don't want to put that money in to do the research. And the cons is there are generally more fees associated with the funds of funds. So you don't have to do the due diligence and the research, but you're going to have to pay some fees. So it's kind of a pros and cons of it.
Right, so this is just a little graphic about what Shane was talking about. So this is the fund of fund that he was talking about. So many institutional investors who don't have that much money will invest into a fund of funds. And inside of this fund of funds, they have multiple different private equity funds to mitigate the risk that could happen if one of them is not successful, right? And inside of each of these private equity funds is different companies that they're investing in.
So, identifying candidates for an LBO. The main factor that determines whether or not a company is an LBO target is whether it can pay off its future interest in principal payments. So, if you think about it, why would you carry out a leveraged buyout if you don't want to pay off the interest in payments? However, there are additional components that can make them viable targets for an LBO that we're about to talk about. So yeah, here we have a nice graphic by our graphic team that shows us what candidates for an LBO might look like. So, strong management. Management is one of the most important characteristics of the firm. Work closely with the management and pay off both the principal and interest of the debt. As I was talking about before, they're not replacing the management in these LBOs because the management is agreeing with the sponsor firm to do the transaction. So having good management when doing an LBO is important because you want them to keep working hard and then making profit for the company. Low leverage. So leveraging of debt instead of equity, LBO sponsors seek to fund their operations through debt. Unused debt capacity can leverage more debt. A strong asset base, collateral to persuade lenders into lending money. It doesn't mean that the firm assets are high value, but also tangible. And the assets are with high liquidity. So obviously if their assets are easily like have high liquidity, you can easily turn them into profit. Like for example, cash, and you easily use that to buy something in transaction. Whereas if all their stuff is tied up in debt and stocks, it might be a little harder. Then we have low business risk, always very important making an LBO. If you want to make profit off it, it's very beneficial if it's low interest. Low risk, because having high risk means you can go bankrupt and lose all your money. Stable cash flows, it's all kind of related to a strong asset base with higher liquidity. So stable cash flows are essential for supporting increased debt and ensuring reliable debt servicing, and they have lender confidence. So if you're confident, it's going to build lender confidence because you have good cash flow, you know the money's going through, you know it's liquid, and they're going to invest. Out of favor, this is undervalued or out of favor companies for LBOs. As we were talking about earlier, many LBOs are undervalued companies, so they're able to be bought for less and turned into a profit for more. And last but not least, divisions that don't fit the firm. They frequently encompass divisions of larger firms and spun off or sold in LBOs to unlock their potential. So by doing an LBO, you can take that target company, make more out of it, and then reach the untapped value within the company. And here are our credits. And that's it, guys. It was a short meeting today. You know, we didn't have on or Eddie. It was just me and Reed, but thank you all for all coming. And yeah, that's it.